Good evening and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending January 26th, 2024. Appreciate you all tuning in. I am host of InvestTalk, Justin Klein, and today I'm going to title the video, The Mag 7 Stalls as the Fed Meeting Looms. And that's what we have next week. We have the Fed meeting coming up on Wednesday and their announcement for future rate policy and other types of policies, not just rates, talking about potentially winding down QT. That will be a big factor. You also have the Treasury on Monday that is going to do their quarterly refunding announcement and how they're going to do that, whether they're going to issue long-term debt or short-term debt. And that is going to have a huge impact on liquidity and what I think will be the trends in the market over the coming uh, months. So next week is a big week. Okay. Um, we're going to get into the charts, but as usual, I want to go over the economic data and kind of explain to you what the likely path forward is for the Fed, at least when it comes to interest rates. And we're talking about the Taylor rule, and I'll break it down real quick. But let's go over the economic data first. We had the Richmond Fed Manufacturing Index that was at negative 15, 3 straight months in negative territory. So in the Richmond region, Virginia, on the West Coast, or sorry, East Coast, you have certainly negative conditions. Kansas City also negative 17 for what's that, 5 months in a row here. So the manufacturing sector continues to weaken. New single-family homes sold, however, did increase 664,000. So with rates dropping into year end, that certainly helped the housing market in a big, big way. Continuous claims for actually, let me do this first. Pending home sales. This was on Friday. This is kind of a note. Talk about the rebound in new single-family homes. Remember, this is new single-family homes, not existing, and it just shows you that if rates come down, that brings a lot of buyers off the sideline, and where they're finding new inventory, that's going to be in the new home market. So that's why the new home builders are doing relatively well. Pending home sales, however, this is new and existing homes. Year over year, we are now positive. We're back to growth in pending home sales. Not big, not exciting, but you can see that the housing market is not falling apart. It's not great, but it's also not going to hell in a handbasket either. So something to take note of. Initial claims for, not initial claims, continuing claims. Initial claims could typically get all the headline news, but continuing claims are the most important because it's not about if you lose your job, it's if you lose your job and you stay without a job. And what was interesting, basically since November, financial conditions could eased through the fourth quarter, and that helped this situation where more and more people got jobs, right? You had this trending higher throughout uh, basically the late summer into let's call it Thanksgiving, and through the end of the year, it was improving. Now, this last week, a pretty big jump here of nearly 30,000 jobs, 30,000 more people unemployed and staying unemployed. And then Friday, you also had the core PCE or the inflation numbers come out. This is the most important, 2.93 tick down from a little over 3 to a little below 3. We're still kind of in that 3 range. Remember that number because we're going to use this number in a calculation in a minute. The broader PCE index, that was at 2.6, but the core is what the Fed tends to look at. Okay, core PCE. Everyone looks at CPI, and that's a headline, but core PCE is pretty close to what the Fed likes to follow. Same with the 12-month trimmed mean PCE inflation rate, also 3.3. So let's just call it 3%, okay, which we'll get into, like I said, in a second. Total vehicle sales, that did continue to tick up. So despite a few more people unemployed, and they're staying unemployed, and the manufacturing index weak, vehicle sales continue to be solid and trend higher. And a lot of that has to do with, I think, prices are coming down, they're becoming more affordable, inventories are right-sizing themselves, and those people that were kind of priced out of a new car are finally coming off the sidelines. So that's a positive for that part of the market or the economy. Let's look at the Fed. So Fed meeting on Wednesday, there's a 97% chance that there will be a pause, but you have about a 50% chance that in March there will be a cut. Okay, it's kind of where you're at, 50-50. But by December, you have roughly about 5 cuts priced in here. Okay, but let's talk about why. And it has to do with the Taylor rule. And this has been a guiding guidepost calculation for where the Fed funds rate should be based on the underlying economy. So let's talk about that. Okay. So this is the formula of the Taylor rule. R is the nominal Fed funds rate. Right now, the Fed funds rate is in a range between 5.25 and 550. The actual, I'll show you this, the effective Fed funds rate. Effective, here we go. So they have a range, but the effective is 5.33. Okay, so the range is 5.25, but really the Fed funds rate has been at 5.33 for a while. Okay, you can see this day by day. Been flat since August, right? So the Fed funds rate has been at 5.33 for, nearly 6 months now. But let's go back to the Taylor rule. Here's the equation. P, the current inflation rate. Remember I said 3%, right? We're going to call it 3. And then you're adding 0.5 times Y, which is the deviation of the current real GDP and the long-term linear trend. Now, long-term, the average expected by the CBO is 4% between 2026 and 2033. Okay, so we're going to call the long-term trend 4. And we just had GDP figures for the fourth quarter, and the average rate for growth of the economy in the entire full year of 2023, right? Because you don't want to just look at one quarter. It was 3.1%. So that was about 3%. So you're talking about 4 is long term, currently at 3. So you're saying, okay, I'm going to take 3 minus 4, right? The long term, and you get -1. So what's 0.5 times -1? That's -0.5. Okay, so right now we're at 3, basically minus 0.5. So far at 2.5, right? 3 minus 0.5, 2.5. Then we're going to add 0.5 times P minus 2. Okay, so what's P? Inflation rate, back again, that's 3. So 3 minus 2, 1.5. So we're going to add back another 0.5. So we basically back to 3. Then we're going to add 2. That's 5. Well, where are we now? We're at 5.3. Okay, so the Taylor rule is basically saying today we should be at 5. And so I think that's why the Fed is saying we're going to cut. And because they're on guard to cut, let's just say that. Now I think they need a catalyst for that, but you can see that this is a good proxy for the way they're thinking. Now, if inflation continues to ebb, and they haven't talked last Fed meeting about how yes, the 1-year rate of inflation is 3%, but if you take the 6-month annualized, right, just looking at month-over-month readings for the last 6 months, and you take that and annualize that out, we're actually about 2. And so as we get into the middle of the year, back half of the year, if that trend continues, the Taylor rule will likely, as all things being equal, if the growth economy stays, okay, around the 3% level, then that 5% target should actually go to 4. Okay, so that's what's happening here. And that's why the Fed or the market is pricing in this going all the way to 4 by the end of the year. A lot of things could change, inflation, economy, etc. But that's an explanation of kind of where we're at and why the market is pricing in what it's pricing in. Okay. Now let's talk a little bit about the market. Talk about the Mag 7, and we're in the midst of earnings season. We had Intel announce earnings. It's been an uptrend, but this did kind of come back down to earth here. You also had, I believe it was AMD that earnings that fell on Friday as well. So, but overall, the XLK, if you look at XLK, this was an overbought situation. This is what we call a topping tail here. It's called a doji candle. You open the week and close the week around the same price, but you have a lot of price action above. Usually, it closes in the bottom 2/3 of the candle and on elevated volume. And you did get that, not extreme volume, but certainly elevated volume for technology. But if you look at other sectors like industrials, here's the weekly on industrials, that's more of a consolidation pattern. And if you look at growth to value, you also have another kind of topping tail here and a lower high. So now we have to see some follow through next week, but we obviously have catalysts with a bunch of earnings from uh, Apple, I think Microsoft next week. But the weakest company in the Mag 7 is Tesla. Netflix had good earnings, but actually did have a good follow through. So that had good earnings overall. That was the best of the bunch for sure. But overall, what you're seeing is a potential topping pattern here in the Mag 7. This is growth to value. Look at this. And if this gets follow through next week, that could spark a broader sell-off in the markets because of how heavily weighted the small caps, or sorry, the Mag 7 is in the major indices. Small caps didn't get much traction this week. A mini bullish pattern here, but that needs to kind of resolve itself one way or the other, but still is in an uptrend from the fall. Let's take a look at the NYSE. That one did close at new highs, so that's a positive. The VIX, that still remains pretty subdued. So, that's not signaling there will be a breakout in volatility. And it could just be a rotation. It may not be a broad market sell-off. It could just be a rotation out of tech and into the harder assets. Move index, treasuries, look at that. I mean, that's a positive. The credit markets are hanging in there. That move index is an indicator that the treasury is not going to be issuing a lot of duration. They're going to stick with a lot of short duration T-bills, and that's something that will certainly impact markets. Like I said at the top of this discussion is really about how the Treasury handles it. It's not just about the Treasury anymore. It's not just, or sorry, it's about the Fed anymore. It's about the Treasury and the Fed and how they're working together to keep our debt situation kind of moving along. It's not tenable, but it's manageable. Let's just say that. But the credit markets are holding in there. Here's the credit spreads. They continue to tighten. Remember this uptrend, short-term credit, short-term junk. That's sorry, short-term treasuries, the short-term junk. That's an uptrend, and that means everything is hunky-dory for now in the credit markets. Let's see, what else do I want to get to? Anything else? Oil prices did have a good week. So that was of note as energy has been one of the weaker sectors. You're getting some traction there to the upside. So I wanted to highlight that because that was probably the biggest story of the week as we head into the Fed meeting. Gold did kind of hang in there. We'll see what reaction we have during on the Fed meeting. That will certainly have that'll be important to where gold prices go next week and beyond. 10-year Treasury that did continue to march up, but we're not really breaking out to the upside. So we'll know more once next week kind of resolves itself. But yeah, I'll leave it there. Still kind of, I would say, short term. I'm gonna turn short term slightly bearish. We're overbought. You're getting a MACD divergence here on the S&P. right? New high, but MACD's not making a new high. You're getting that topping tail in tech when we know tech is a large portion of the broader index. Let's go look at C1PQ Nasdaq. Yeah, you're getting a bit of divergence here on the Nasdaq as well. So that's telling me that this high is something that you want to be fading to a degree. And as we go into more earnings from the Mag 7 and Treasury refunding and the Fed announcement, there are a lot of catalysts for potential downside. And when you're this overbought, it's hard to get much more upside. So we certainly need a refresher in the markets. It's not something that I think you panic about. Normal pullbacks should be expected when you're this overbought. We moved this far, this fast. So that's what I'm seeing, and that's why I expect next week to be a down week. But anything can happen in this market. And with that, I'll leave you. Hope you have a wonderful weekend. A reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated.